What's up, everybody? This is going to be our Options 101 video. We will be going over the basics of what options are in this video. We will explain what everything means on the options table, and we'll give you all a basic, quick example of when to buy an option contract. So let's get this started. What is an option? An options contract is an agreement between two parties to facilitate a potential transaction on an underlying security at a preset price, referred to as the strike price, prior to or on the expiration date. Essentially, an options contract is the right, and again, it's not mandatory, but it is the right to buy or sell 100 shares of a given security at a given price by a certain date. So you may have a few questions already, and that's okay. Just know that we will be going over expiration dates and what the strike price is here in a minute when we look at the options table. Just a quick key note on securities. Anytime that we talk about securities, just know that we are talking about things that are tradable, okay? So like Apple, Apple's ticker is AAPL. That is a stock. QQQ, which is the NASDAQ's ETF. That is also tradable. That also has options and so forth. There's going to be examples for REITs and a few other things. So don't worry if you don't understand something, we've got you covered. So on the last slide, I briefly mentioned something called an options table. You might have asked yourself, what is an options table? Well, here is a visual example of an options table. This is taken from Webull, which is a brokerage. Your options table is going to give you all the information you need to know about your particular options contracts. It's going to give you all of these important numbers here that are columned out individually. It's going to give you your expiration dates, your strike prices, and so forth. All of this may look a little confusing, but let's go ahead and let's break it down kind of column by column. So here is our options table zoomed into one side. You'll notice on our upper row here, we have in order from left to right, our strike price, our bid, our ask, our last, our implied volatility, volume, open interest, then the delta and the theta on our contracts. So to break those down individually, let's go column by column. The first one was a strike price. So what is a strike price? Strike price is a set price at which an option contract can be bought or sold when it is exercised. As a newer trader, you don't really need to worry about exercising a contract, as that is a more advanced strategy for a different video. Just understand that your contract will expire by its expiration date and that you will need to be out of your trade by the end of expiration. So here is our visual example again of our options table. And on the left column, right, we have our strike prices for our particular security. Now, for call options, the strike price is where the security can be bought by the option holder and vice versa, right? So for put options, the strike price is the price at which the security can be sold for. And if you remember from our first slide, the definition of an options contract, right, is the right to buy or sell 100 shares of whatever given stock you're looking at a specific strike price. So to use the options table, for example, if you take that top strike price of 304, for the calls, you are agreeing to buy 100 shares at that 304 strike price. And then if you have the put, right, you have the right to sell 100 of those shares at that 304 strike price. Now that we've touched on strike prices, let's go over expiration dates. What is an expiration date? An expiration date is the last day an options contract is valid. Before an options contract expires, the owner can choose to exercise their contract, close their position to realize their profit or loss, or let their contract expire worthless. As someone who is newer to options, don't worry about exercising your contract, as that puts you on the hook to actually buy or sell 100 shares of that particular security. And as options traders, 99% of the time, we look to close our position and get out of our contract with profit anyhow. One last thing real quick on expirations. The farther out the expiration in general, the more expensive the contract will be. And the closer the expiration, the cheaper your contract will be. You're essentially paying for risk and reward here, right? So the closer the expiration, it's a higher risk, higher reward strategy. And the farther the expiration, right, is a less risk, but less reward strategy. Now that we've gotten strike prices and expirations out of the way, let's go over the prices of these contracts. A bid-ask spread is the difference between the highest and the lowest price the contract is going for at the current time. If you are buying a contract, you're going to try and get the best price possible or the cheapest price possible, which is known as the bid. And if you are selling and trying to get rid of your contract, you are trying to get the highest price possible, which is known as your ask. Whatever you end up paying for your contract, by the way, is known as premium, right? So you are paying or selling for a premium. One other thing you will need to know about your contract is its implied volatility, also known as IV. IV is a metric that captures the likelihood of changes in a security's price. There's some math involved with determining IV, but just understand that the higher the IV, the more expensive your contract will be. And of course, the lower the IV, the cheaper your contract will be. Two other important metrics of your contracts will be its current volume and open interest. Volume is the current number of contracts traded for that particular day, and the open interest, also known as OI, are the total number of contracts out there in the market currently, right? Generally, you want contracts with good OI and volume. There are some exceptions, but as a newer options trader, stick to option contracts with good liquidity or higher volume and OI for the given security you are trading. Now, here we have an example of an options contract with good volume and OI. You will notice the volume is significantly greater than the OI here. This isn't necessary to get a good profit, but higher volume than OI can be a great indicator showing where the public thinks a security's price is going. In this example, we have a lot of volume on the 315 puts, and sure enough, the security's price was moving down pretty much all day. The higher volume and a close one-day expiration, which is a risky expiration, were good indicators that the price was going to come down. So we've covered a lot already. Now we need to go over the Greeks for your options contract. Then we will get into an example trade of a contract. There are other Greeks out there, but arguably the most important ones are going to be your delta and theta of a contract. Delta is a metric that estimates the change in the price of an options contract given a $1 move in the security's price. And theta, also known as time decay, refers to the rate of decline in your options contract on a daily basis. So here we have our options table again for a particular security called XLE. These are call options for XLE. And here are our visual examples again of our delta and theta. With a delta of 0.5743, if XLE's stock price increases by $1, then this contract's price will increase by $57, right? So that 0.57 decimal. And then for a theta of 0.0669, by the day's end, this contract will lose about $6. So all you're doing is you're essentially timesing your decimal point there by 100 to get your change in delta for your contract and to get your change in theta for a contract. Now that we got all that out of the way, let's get into an example of when to actually trade a contract. To make this and keep this as simple as possible, you'll want to buy calls when the security's price is going up, and you'll want to buy puts as the security's price is going down. Now, there are some more advanced strategies for trading options, but we'll keep this on the most basic example. So here we have QQQ's chart for the day. And let's say right around here, we thought it was a good time to buy puts since QQQ's price was dropping. Quick side note, obviously we're looking at this chart with hindsight, right? The day is already over. You'll have to determine your strategy for your entries and exits and so forth for live during the trading day, right? Everybody has a different trading strategy and everyone has different risk tolerances, almost more importantly. So your strategy will have to be something you develop and practice test first and preferably a lot before you actually start trading. We'll talk about more on stuff on that later. We'll cover it in different videos, but let's stick to our example here. So for the example, we are choosing to buy puts here for whatever reason, right? For whatever strategy you're using. If we go and we look at the actual value of the contract on a chart, this is where we bought in relation to QQQ's chart, right? So we bought in for 360. Now, if we go back to QQQ's chart, let's say we like our profits and we want to exit the trade, let's say right here. It looks like we could have made a little bit more money if we held, but again, greed is never a good thing when trading options. So we liked our profits, we're taking profit here. Since we are exiting here, we will be able to sell our contract for a premium of $740. Since we paid $360 for our contract and we got $740 in return, we made $380 profit or 105%. So some note taking here is encouraged. Go back into the video if you weren't following along and taking notes as you did so, and write down some key notes for yourself and ingrain them into your brain, please. What is the definition of an option? What is the difference between delta and theta, etc., right? This was meant to be a very basics options video. So if you have any questions about what the video went over and something maybe more advanced or not covered in the video, feel free to reach out in the comments below, the DMs, or join the Discord, right? We'll see y'all next time.